Welcome to the Freedom Capital Management Strategies Quarterly Market Review and Outlook. I'm Brian Zabora, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, we had equity markets near or at all-time highs at the end of the quarter, both the S&P and NASDAQ. Could you unpack the trends in equity markets during the quarter?
Absolutely, Brian, and thank you all for joining us today. When we look at headline market indices, especially in the US, like the S&P 500 and the NASDAQ, we saw really strong gains in the second quarter, which built upon the strong gains in the first quarter, leaving those indices up substantially for the first 6 months of the year. For example, the S&P 500 is up over 15% through June 30th, which is a really strong start to the year and continues on the great gains from 2023. But when we step back and look under the hood of those markets and of stock markets at large, the picture wasn't quite so optimistic and pretty. And when we look at other areas of the market outside of the big stock market darlings, these technology companies like the Nvidias, like the Apples, the Microsofts of the world that have seen exceptionally strong gains, most other stocks actually struggled in the second quarter. When we look at the Russell 2000, an index of small cap stocks or smaller companies in the US, those stocks collectively declined by a few percent in Q2. If we take the S&P 500 and those 500 stocks and equal weight them, and we look at an equal weighted version of the index where every stock is represented by the same amount in the index, those stocks collectively were down by a few percent in the second quarter, meaning that most stocks in the US markets were down. International markets also saw declines last quarter. So we had this really interesting dynamic where the headline indices posted pretty strong gains, but underneath the surface, most stocks actually were struggling last quarter and posting declines.
Turning to the fixed income market, we saw bond markets pretty flat in the second quarter. Bonds are down slightly for the year. Could you help us understand why?
Absolutely, and it really helps to zoom out to a multi-year perspective for bond markets. So if you go back about 3 years, interest rates were at historically low levels around the pandemic period as the Federal Reserve really dropped interest rates to about zero. And that was a period where bond prices actually rose quite a bit. But we had an interesting dynamic when the inflation problems came in 2022. We saw interest rates rise sharply higher. And what happened because of that is with the sharp rise in interest rates, bond prices declined. And they've been continually declining for the last couple of years. So we actually find ourselves in a bear market for bonds, which has really challenged fixed income investors. Bonds have posted losses over the past 3 and 5 years, which is very unusual. And so the forward-looking outlook is a bit different because higher interest rates that are now in place should mean higher yields and higher returns going forward, but the road to get there has been very challenging, and we're still in the midst of this bear market for bonds, and the first half of this year continued that trend.
Pete, turning back to the equity markets, we saw in the 1990s euphoria around technology stocks create a bubble. Some may say that the euphoria around AI is creating a bubble. Could you give us your thoughts?
You know, a question on a lot of investors' mind today is, are we in the midst of another stock market bubble? And that's a very difficult question to answer. But one of the periods that does have certainly a lot of parallels to today is the late 1990s. And if you look at those periods, there's some similarities, but there's also some differences. When we look at the key similarities, we're seeing stock market gains being driven by a select group of technology companies that are really part of a transformative wave of technology development. In the 1990s, it was the commercialization of the internet, and the poster child for that period was Cisco. If you look at today, it's the commercialization of artificial intelligence, or AI, and the poster child today is Nvidia. And if you look at the stock price gains in markets at large, and in those stocks in particular, there are a lot of parallels. The other similarity is any part of the market that is not exposed to those themes has really disappointed and underperformed, whether that be small cap stocks, whether that be value stocks that are not tied to these technology themes, whether that be international stocks. So you see some similarities there. And then the final similarity that we'll note is you do see this increased and have seen this increase in retail trading activity. In the late 90s, it was the prevalence of day traders. Today, it's more around meme stocks, 24/7 trading, cryptocurrency, but you're seeing some commonalities in terms of retail trading activity really picking up. So those are the similarities, but there's also a few key differences, the most notable of which, when you look at the market darlings and the market leaders of today, often referred to as the Magnificent Seven, and those are the companies of NVIDIA, Apple, Amazon, Google, Meta, or Facebook. Those companies are large, they've seen exceptional stock price gains, but they're also highly profitable and well-established businesses. They have very strong balance sheets for the most part, they're sitting on a lot of cash, and they can actually invest in their businesses to fund growth. That is a pretty stark contrast to many of the technology darlings of the late 1990s that were not profitable, that were reliant on external capital to fund their growth, which made them much more vulnerable to a dry up in capital market conditions. And that's what we've seen. Even though there have been higher interest rates in recent years, these companies have continued to thrive as they've been able to reinvest in their businesses from cash flow. So that's a notable difference, and why we think that while there are some parallels, this period is distinct from the late 1990s for equity markets and investors.
Turning to the economy, Pete, it seems to be that the consensus is that it's going to be a soft landing, and certainly we're seeing enthusiasm in the stock market. What risks are you monitoring currently?
There's certainly a growing sense of optimism among investors, and particularly stock market investors, that the economy is in the all-clear zone. There was a lot of talk about recession the last couple of years, and that talk has really died down, if not disappeared, from most of the financial press. And it's led many to say that the Federal Reserve has achieved the elusive soft landing that we've been talking about over the past year and a half. And when we look forward and we see how optimistic conditions are, we as investors still need to focus on what are some potential risks. And for us, there's really three that we're monitoring. The first is, will higher interest rates ultimately slow down economic growth? Or will the economy continue to defy the gravitational pull of the higher interest rates we've seen over the last couple of years? And so far, the answer has been a resounding yes to the economy being able to ascend despite higher interest rates. And we think there's a couple reasons for that. The first is that U.S. consumers entered this period of higher rates in a very healthy position. They had very low debt levels and debt service levels. The job market was also very healthy, so income was strong. And then house prices and asset prices had grown, so their balance sheets were healthy. So you had a healthy consumer, which was able to weather these higher rates. And the other dynamic that was unique was that when interest rates got to very low levels during the pandemic back in 2020 and 2021, most households and businesses took that opportunity to lock in low interest rates for long periods of time. And in doing so, even though rates have risen since then, those longer term fixed rate debt payments, whether they be mortgages for households or they be just traditional debt for businesses, are still at very low interest rates, even though the rate environment has shifted. So far the answer has been yes, but we're still watching that closely because high rates remain, and at some point debt will need to be refinanced, and likely at higher rates. The second question that we're asking as a potential risk factor is inflation truly and durably tamed, or is it at risk of reaccelerating? What we've seen over the past 18 months or so is a sharp deceleration in inflation. And that means inflation rates have come down from exceptionally high levels like we saw in 2022 to much more normal levels today that are closer to 3% a year. The Federal Reserve's target is 2% a year, and as we're getting closer to that, the progress toward it has certainly slowed, and we've seen some hiccups in markets. And I spoke earlier about higher rates impacting bond markets this year as an example of that. So if inflation were to either stop decelerating or reaccelerate, that would be problematic for both stock and bond markets, as higher rates would likely lead to a reset in valuations akin to what we saw in 2022.
Pete, you've highlighted interest rates and inflation as risks. What about geopolitical risk?
Geopolitics is something that's certainly on our mind, isn't on the mind of most investors. And when you look at the various events taking place around the world, we've had consequential elections in many parts of the world in the first half of the year. Right now we're seeing it in France and surprise elections that are taking place there. And then obviously we have the US presidential election this fall. And geopolitical risk is something that we tend to focus on because there's a short-term impact on markets, but because it's highly unpredictable, the long-term impact is very difficult to gauge, so we don't spend too much time emphasizing it. That said, we are focused on it more this year than we typically are, but the reason for that is an interesting one. It's while these are all known events and known risks from a market standpoint, we've also seen a lot of optimism creeping into markets and a general sense of rising complacency. And the way we measure that is when we look at volatility in markets, particularly in stock markets, which is measured by the VIX index, that has fallen to very low levels. And with so much geopolitical event risk at play this year, it's unusual to have the volatility be priced at such a low level. So there's a disconnect there that we're trying to figure out, and we think it has the potential to create some increased volatility in the second half of the year.
Pete, there's lots of cross currents in the markets, both in fixed income and equity markets that you highlighted. Could you leave investors with some thoughts?
Absolutely, and as always, there are a lot of moving dynamics in the global economy and capital markets, and it's incredibly difficult to predict what will happen in the future. And so we always advocate for investors to stay disciplined and focused on a long-term plan. That is the bedrock or the guide to your personal investment plan. And it's incredibly important to stay focused and disciplined to that, especially amid some of the more emotionally driven investment decisions that many are drawn to and called to, especially with some of the sensationalism in the financial media. So it's important to focus on that. And one of the things today of note is that when you see these small groups of really profitable technology companies that are seeing exceptional gains, while those are great companies and certainly have a place in many portfolios, being over allocated in those areas and losing some of the diversification in your portfolio can present unique long-term risks that are maybe not unnecessary in the context of your plan. So that's where you stay engaged with your financial advisor, stay focused on the long term, and stay diversified. All critically important elements of a successful long-term financial and investment plan.
We thank you for those details. Thank you for joining us today. We look forward to updating you on economic and financial markets at the end of the third quarter.
Thank you.